Hello, Professor. Today we're going to talk about the ratios and financial analysis for Pouch Health until rebrand. This is the group number 10. So first of all, we're going to talk about the Pouch Health ratios analysis, initially with the liquidity ratios. So first of all, we can see the current ratio improved by 0.22 from 2022 to 2023. This means a 21% improvement between the two periods, showing a better short-term financial health. As well, the network capital increased almost $1,000 million from 2022 to 2023, reflecting again the positive liquidity position of the company. And last but not least, the network capital to assets shows the company ability to meet short-term liabilities with improved liquidity. In this case, the ratio improved almost three points on the second decimal place. Now talking about the solvency ratios, we can see the total debt ratio and the debt to equity ratio in this table. Initially, we see the total debt ratio that is being shown stable at the point, which shows high financial leverage of the company. On the other hand, debt to equity shows negative in 2022, which is alarming because it exposes the liabilities exceeding the assets, but less extreme that in 2021. However, it's still concerning. This shows the leverage of the company is remain highly leveraged, which could signal a financial risk. And both demonstrate as a debt strategy reliance on debt for financing, but not entirely depending on it, as we're going to see from now on. On the other hand, we can see turnover ratios. We can talk about first the inventory turnover and the days in inventory, which, as we can see in days in inventory, it went from 172 days to 224. That it shows that it increased 52 days. And also the inventory turnover went from 2 to 1.63, which again shows the slower inventory management and turnover that this company has been using for the last period recorded. Now also we can see the total assets turnover that increased by 10%. This means 0.03 points from 2021 to 2023. That shows higher efficiency in generating sales with existing assets. Finally, on Pouch, we can talk about the market value and profitability ratios. So for the P ratio, we can see that there are deeper losses, as also shown by the profit margin that went negative, actually more negative than in 2022. So it exceeded from minus 2.8 to minus 6.8. So this may raise red flags for actual and potential investors, and there are visible profitability issues indicating the company fails to maintain any margins.
When analyzing theorized liquidity ratios, we can see that the current ratio is quite stable among 2 points every year, meaning that they have enough liquidity to meet their short-term obligations. But when we see the net working capital ratios is just above 0, meaning that they are not taking advantage of all their long-term assets. Then when we analyze the following ratios, there, next, thank you, the long-term solvency ratios, we see that the numbers are positive, but they are having a conservative financial strategy since total debt ratio is between 0.2 every year, all of these 3 years. This is a healthy situation in terms of total debt ratio. And when we analyze debt equity ratio being in less than 1, it means that their operations are financed with their own equities instead of with debt, which is good, but perhaps they are missing opportunities for faster growth, or they are not maximizing the shareholders' returns, rather than if they were doing that with debt. The next one, we can see that during these 3 years, their inventory has been selling twice a year. Their numbers are quite steady. They are showing the same trend. It's a steady trend. the numbers doesn't show significant changes. And the good things, they seem to be improving their asset utilization, since in 2023, total asset turnover is increasing in comparison with the previous years. The next one, when we analyze profitability ratios, here we see that they are losing money. Even though 2022 represent a very bad year in which they lost 43% of equities, and for every dollar of income, they were losing 2.3 Canadian dollars. In 2023, we can see a better situation, even though it's still negative, but it's closer to zero. Closer to zero. Perhaps this is the right strategy. They took a better strategy from the previous years. Lastly, when we analyze the market value ratios, we see that in 2021, numbers were pretty good. Price earning ratio was 270, perhaps meaning that investors had high expectations on the company, on the cannabis-based products. But then again, in 2022, they were in a bad situation, continuous losses. And in 2023, the situation seems to be improving, but we have to see in the following years if they can turn this situation into positive numbers.
Having analyzed the financial ratios for both company, it was important also to understand how these companies are performing inside the industry. So we made the analysis for these companies into the industry. The industry that they work is the pharmaceutical and medicine manufacturing, and the period analyzed was 2023. So let's gonna take a deep look on the liquidity, solvency, and profitability ratios for each of them. So talking about liquidity ratios, Bausch Health and Tilray both have significantly higher net working capital compared to the industry, indicating a strong short-term liquidity. And on the other hand, the current ratio show that Tilray's current ratio is 2.27, is much higher than both the industry that it was 1.2, and Bausch Health that it was 1.3, suggesting a strong liquidity position. Furthermore, the solvency ratios for Bausch case has a concerning debt ratio of 1.003, which means its total liabilities exceed its total assets. But also, the company has a debt to equity ratio extremely negative. It was minus 334.54, which indicates a red flag for the company, and it's likely indicates a negative shareholder equity. And finally, about the profitability ratios, both companies are operating at a loss, basically, but Bosch company has a profit margin of minus 6.83. That is significantly worse than the industry average, being 3.59, and the other company that it was minus 0.28. Both companies showed a negative return on assets, indicating that their assets are not generating positive returns.
So analyzing now the cash flow for Bausch, we can see that for the operating activities, even though they have losses, they have net loss, they have increased the net loss and have increased their inventory. We can see that thanks to the change in operating assets comparing to 2023, they have provide cash in these operating activities. According to the investing activities, the net cash used in the Bausch has still improving their acquisition in new businesses to still making a stronger operations from themselves. So we can see that the cash flows from investing activities in this year is negative, is because of the increasing of investment in new products. Now, in terms of the financial activities, we can see that they are still having leveraging themselves in long-term debt. Comparing to 2022, this in 2023, they're still having less long debt, but we can see that the issuance is still going around, but also the repayment in this case is being less. But the difference between the issuance and the repayments in this case made that for the Bausch company, they have more cash in financial activity, showing them increasing their debt, and they're still like managing more debt to repaying like
a lot of things like the acquisitions we talk about. So we can see that for this year, they're not struggling. They're being successful according to the operative activities, but also facing some struggles in the long-term debt and facing net losses, but improved cash flow and continue investings. Now analyzing the till rate in cash flow, we can see that for operating activities, in 2023, they were struggling according to 2022. This is basically because of the net loss, even though they have decreased in their net loss, but also the prepaids of current assets in these years, they have to use many cash in this case. So for 2023 was pretty bit more struggling. In the investing activities, in this case, we can see that the mercantile securities have created themselves more cash in this year, even though they have still investing in new acquisitions as new companies all around the Canada and the USA. So finally, in the financial activities, we can see that the net cash in this was negative. This is good because we can see that they are still issuing like a long term, but the repayment of the long-term debt is still higher than the issuance. So we can see they've been like quite good management of the debt. It's not bad that they are still having debt, but this is also good that they are still a little bit more responsible with this. So we can see that even though they are struggling in the operating activities in 2023, we can see that they're still repaying obligations and still investing, but their productive assets still bringing cash.
So given this analysis, we can conclude that even though both companies are facing financial difficulties, Tilray is a stronger company based on the following statements. So first, short-term liquidity. Both companies show a stable net working capital and current ratios. Second, about the long-term solvency challenges. In Bosch health case, high leverage, negative equity, and low profitability shown in the negative return on equity and profit margins. And Tilray Brands has a lower reliance on debt, but struggles with profitability. And in terms of industry comparison, both companies underperform industry average, signaling a financial instability.
So we can see that finally for the cash flow and the debt, we can see that Tilray has a better management of the debt. And also, even though they have struggling with the operating activities, we can see that the net loss is still decreasing, and for Bausch is still increasing. So there being like more efficiency, and the issuing of the debt is less than the repayment of themselves. But also, as a company that is still making investments to improve their operations. So thank you very much.
Thank you.